Welcome to the deep dive. Today we're looking at maybe a different angle on crypto trading.
Yeah, moving beyond just chasing those big price jumps.
Exactly. We're diving into this idea of selling options. And we're using Delta Exchange as the specific example platform here.
hmm Our source for this is an educational video transcript. It
Okay.
sort of walks through how it works and maybe why it could be interesting.
Especially like when the crypto market isn't really going wild, right? When it's just kind of flat.
Right. So the core question, really, is how do you actually do this on Delta Exchange? And why would you even choose selling over, say, buying options? Especially for crypto.
Okay, let's get into it. The transcript it kicks off with that exact question, why sell instead of buy?
And the big reason they point to is something you see a lot in crypto, these long periods where the market just trades sideways.
Yeah, no huge ups, no huge downs, just consolidation.
Exactly. And what's interesting is how that sideways movement impacts options. The transcript brings up beta decay.
Ah, theta decay. Right.
It's, um, think of it like an option having a shelf life. As it gets nearer to expiring, its value tends to drop.
Especially if the coin price hasn't moved much.
Precisely. That time-based value loss, that's theta decay. And it's usually bad news for the person who bought the option.
Right, because if you bought an option hoping for a big move and the market just sits there.
Your option loses value purely because time is passing. Challenging bet.
And this is the interesting part, that same theta decay, the thing hurting the buyer.
How it can actually help the seller.
Yeah, because as time passes and if the price doesn't move drastically against them, the option they sold becomes cheaper.
Allowing them potentially to buy it back for less and pocket the difference.
So this could be a way to potentially profit even when the market's kind of boring.
That's the core idea
Sure.
presented, yeah. And something else they mention adds to this. The daily expiry of crypto options on Delta Exchange.
Oh, daily. Okay.
Yeah, 5:03 p.m. every day. This really short lifespan, it intensifies that theta decay effect.
So selling an option that expires today or very soon becomes maybe more attractive if you think things will stay calm.
That seems to be the logic, especially when volatility is low.
Okay. The transcript also quickly mentions futures trading. Different beast, no theta decay there.
Right, just another common crypto method. But sticking with options, the focus here is selling as a strategy for these consolidating markets. It's a different mindset than buying.
So how do you spot a good time to maybe try this? The video suggests an initial approach.
It does. A pretty simple starting point using trading volume.
Okay, volume, how does that work?
It suggests using a volume chart indicator.
Yeah.
You know, the bar is usually at the bottom of a price chart.
Yep.
And the signal they say to look for is when those volume bars, the candles, get really small.
Small volume candles. Meaning what? Less trading activity.
Yeah, the interpretation suggested is that low volume might indicate a lack of strong directional conviction.
Ah, so it might suggest the sideways trading could just continue.
That's the idea.
Yeah.
But, it's presented as just a starting point.
Right, because low volume doesn't guarantee things stay flat, does it? Couldn't it sometimes be the quiet before a storm?
Absolutely. That's a key risk. Low volume can sometimes precede a big breakout. So relying only on this is, well, it's basic.
Just a filter, maybe? An initial idea to consider when thinking about selling.
Exactly.
Now, they also mentioned a specific time window for doing this?
Yeah, the video recommends aiming for between 7:00 a.m. and 5:00 p.m.
7 a.m. to 5 p.m. Any particular reason given for that time frame?
The video actually mentions the demonstration we're about to discuss was filmed outside those hours.
Oh, okay.
So they don't really dig into the why behind that specific window. It's just presented as the preferred time for the strategy.
Gotcha. Okay, so let's walk through the practical bit. Placing the actual order on Delta Exchange based on their example.
All right, first step, obviously, get onto the platform, click the options tab. Simple enough.
And then you see the chain data.
Yeah, the chain data view. It's
Yeah.
basically the list of all the available options contracts, different strike prices, expiry dates.
Kind of like a menu of options.
Exactly. They mentioned it might look familiar if you've seen Indian market data and that there are other videos explaining it in more detail. But for us, it's just where you find the option you want to trade.
And the key decision here is picking the strike price, right? The video example had a specific approach.
It did. The strategy shown was to choose a strike price slightly below the current market price.
Okay, slightly below.
In their example, the market was around, say, 104,000 something, and they chose to sell the 104,000 strike.
So selling a strike that's a little bit out of the money, as they say?
Precisely. If you're selling a call, picking a strike below the current price is actually in the money. If selling a put below is out of the money, let's assume they meant selling a put here, betting the price won't fall below 104,000. Or perhaps they sold a call slightly above the market. The key is picking a level you think the price won't reach or cross significantly.
Right, you're betting it stays away from that strike price, essentially, allowing decay to work.
That's generally the goal with this kind of selling strategy.
Okay, so you pick your strike. Then placing the order itself. They mention limit versus market orders.
Yeah, important difference. A market order just gets you filled fast at whatever the current best price is.
Quick, but maybe not the best price.
Could be. A limit order lets you set your specific price. You say, I won't sell for less than X or buy for more than Y.
More control, but you might not get filled if the price doesn't hit your limit.
Exactly. The video used a market order just for speed in the demonstration.
Makes sense for an example. So they placed a market sell order for one lot or one contract.
Yep, and they noted that once it's placed, boom, you see it right there in your open positions.
And this example was with Bitcoin, BTC. But they said you can also do this with Ethereum.
Correct. Those are the two available on Delta for option selling currently, according to the source.
Okay, trade placed. Now, managing risk, stop loss, and target prices. Crucial stuff.
Absolutely essential. The video shows you find these settings in the position section for your open trade.
And it looks like you can set profit targets using percentages, like 5% or 10%.
Yeah, the example showed setting those targets. And the platform then calculates what price level that corresponds to.
So like 5% profit might mean the option price drops to 1364, and 10% might be 122.99 using their number.
Right, just examples, obviously, but it automates that calculation.
And the stop loss, equally important. How did they set that up?
They showed setting a limit price for the stop loss order first. The platform even suggested a price slightly above the current mark price of the option.
Mark price being this sort of estimated current value.
Yeah, basically. In the example, they use 1517 as that limit price.
Okay, and then the actual stop trigger.
They set the stop limit, again, using a 5% example. So if the option price rose by 5% against them, hitting around 1588, that would trigger the stop.
And the limit price attached to that stop was a bit higher, around 1742.
Correct. That difference between the trigger, 1588, and the limit, 1742, gives the order a better chance of actually getting filled if the price moves fast against you. It creates a small range.
Got it. So it tries to sell between 1588 and 1742 if triggered.
That's the idea.
The transcript then mentioned the P&L at that moment. Tiny profit, like 0.03 USDT.
Yeah, and a potential loss if the stop hit of about 0.25 USDT.
But, and this is key, those numbers were just a snapshot, right? They change constantly.
Constantly fluctuating with the market is purely illustrative, not a real trading outcome prediction.
And finally, they showed you can see all this on the chart.
Yep, you can pull up the Bitcoin price chart right there in the options interface.
And you'd see your entry point, your target level, your stop loss level, all plotted visually.
Which is really helpful, right? To see where your trade stands relative to the price action.
Definitely. And again, they stressed the example trade was just random, no real strategy applied, just showing the mechanics.
Important reminder, educational purposes only.
Okay, so let's quickly recap the main takeaways here.
We walk through the basic mechanics of selling an option on Delta Exchange based on that video guide.
And the core rationale, the why, is this idea of potentially profiting from low volatility in crypto.
Thanks to theta decay. Yeah. Time decay working for the seller when the market's quiet.
We touched on that simple volume indicator idea as a potential starting point for finding opportunities.
And the suggested 7 a.m. to 5 p.m. trading window.
Right. But it's clear this was just scratching the surface, yeah.
Oh, definitely. An introductory look. The video itself hinted at more complex strategies existing. There's a lot more depth to option selling.
For sure. Which brings us nicely to a final thought for you, the listener.
Given that these crypto options, at least on Delta, expire daily, how does that super short time frame change things?
Yeah, how might really short-term news like sudden announcements or